There's a question I get a lot from people in the year or two before they retire. If the market crashes right after I retire, am I going to be okay? And it's the right question, and there's actually a name for what they're worried about. It's called sequence of returns risk, and it's one of the biggest threats to a safe retirement that not many people talk about. Hi, I'm Jackson Baker. I'm a financial advisor with the Baker team at Parkway Wealth Management Group. Let me explain what sequence of returns risk is, why it matters most right around retirement, and what we do about it. You see, most people focus on the long-term average return their portfolio earns, and that's fine while you're working. When you're adding money to your accounts every paycheck, the order of returns doesn't really matter, and the math works out mostly the same. But the day you stop adding money and start pulling money out, that flips. The order of your returns suddenly matters a lot. And here's why. When the market drops and you still have to take a withdrawal, you're selling shares at a discount to cover that withdrawal. You end up with fewer shares left. And when the market eventually recovers, you have less left to participate in that recovery. It's a permanent leak in your retirement plan, and it's caused entirely by what we call bad timing. Returns showing up in the wrong order at the wrong time. Now let me give you a hypothetical that makes this concept concrete. Picture two retirees. Each starts retirement with $1 million. Each plans to withdraw $50,000 a year adjusted for inflation. Over 30 years, both portfolios earn the exact same average annual return of 7%. Retiree A has a smooth start. Their first few years deliver solid returns. Their portfolio actually grows in those early years, even when they're taking income. And after 30 years, they still have a significant nest egg. And retiree B has a pretty rough start. Their first 3 years drop 15%, then 10%, then 7%. Same long-term average return over those 30 years, but those early years force them to sell shares at depressed prices to cover their withdrawals. And by the time the market recovers, there's less of a portfolio to recover with. Retiree B may run out of money in their early 80s. They have the same average, same withdrawals, and same starting balances. Yet the outcomes were very different. And that's sequence of returns risk in a single picture. Now for the good news. You can't control the market, but you can prepare for this. There are 4 things we do with clients at the Baker team to take some of that risk off of the table. The first of which is that we build a flexible withdrawal strategy. If markets are down, we look at whether discretionary spending can take a flex. We take a smaller raise that year and replenish later when markets recover. The second is that we hold cash and short-term bond reserves. This is typically 1 to 3 years of living expenses set aside in stable assets, so a down year doesn't force us to sell stocks at the worst possible moment. The third is that we diversify across asset classes that don't all move together. This will smooth the ride and soften the impact of any single bad year. And the fourth, but certainly not the least, is that we stress test the plan. Before a client ever takes their first retirement withdrawal, we run their plan as if the first few years are bad. If it still works under those conditions, you can retire with a lot more confidence. And instead of trying to predict the market, we prioritize building a plan that holds up regardless of what the market does in years 1, 2, and 3. One last thing to know. The first 5 to 10 years of retirement are the most fragile. That's the window where sequence of returns risk has the biggest bite, because your account is usually at its largest and your withdrawals have their biggest relative impact. So if you're about to retire, or you just did, this isn't a hypothetical, it's right in front of you. It is something to consider getting in front of, not behind. If you're a few years out from retirement or you're already there and the market is making you nervous, we'd be glad to sit down with you. We'll look at your specific plan, model what an unfavorable early stretch could look like, and tell you honestly whether or not your plan holds up. You can schedule a complimentary 15-minute call with us at the link below. We look forward to meeting with you. Thank you for watching.